Hello everyone, this is Carbonomics. Today we're going to be discussing the main issues with investing in carbon capture technology, as there are some details about the industry that people should be thinking about as they enter the space, in my view. So, carbon capture technology refers to any nature-based or technological solutions that take CO2 out of the atmosphere, either storing it or using it in other applications. The main issue that you'll tend to encounter when investing in the carbon capture related companies is that many of them have no real moat. An exception being if a company is in the lowest cost quartile production, um, as you can see here in this graph, meaning they produce a commodity at the bottom of the cost curve. Now, most traditional moats don't exist here, but as we mentioned, the lowest cost producer is the top bullet point. Going down the list, economies of scale do exist, but they aren't going to be very helpful in the performance of a stock or company. All commodity stocks tend to collapse if the price of a commodity does. Network effects are pretty irrelevant in the commodity business. Intangible assets, no one's really going to care about a brand or some of the other common intangibles. All a consumer is really going to care about in this situation is the product. And switching costs are also relevant, because for most commodities, all the product is relatively the same or traded for a few standardized prices. Ultimately, we have to come into investing in the carbon credit space like we would with any other commodity. Although the situation could end up a bit different than traditional commodities over the long-term view, in my opinion. But for now, the industry will behave in the same way a traditional commoditized industry would. And there are multiple reasons that I'll go into in this video, as to why these businesses can be difficult to invest in. The first reason being that these companies are price takers. Any company producing a commodity is producing a standardized good. That typically is going to trade for a few standardized prices, as I mentioned before. That takes all the pricing power away from the producer of the product. A company like Shell, BHP, or Codelco really can't choose their own prices. Meanwhile, Apple can continue to charge more and more for an iPhone each year. If any producer tries to charge more for their product than others, they'll just end up buying that same commodity from someone else. Another reason, as a price taker, you're subject to the price that the market demands for your product. And oftentimes, in economic stagnation, for example, demand for any particular commodity could drop, potentially by a substantial amount in price. So commodity-based businesses behave as cyclical companies, where demand for their products, and in conjunction their business performance, can swing wildly based on the macroeconomic environment. Via the nature of the industry, commodity markets tend to have long, drawn-out periods of low prices. Just look at the price of uranium from its run before the great financial crisis hit in 2008. The industry has had nearly a decade where prices are below what it takes for the average producer to extract, a pound of uranium out of the ground since then. From around 2012 to 2022 at this point, even longer than that. As most of these companies are unprofitable, they burn cash and dilute shareholders until they eventually go under. And this is certainly seen the worst in the mining industry, where it can take up to a decade, if not even more, to bring a new mine online into production. It certainly can be less capital intensive to bring on a new carbon capture project, but it can still take years, dealing with permitting, feasibility, and various regulations or standards that can draw out the process. Ultimately, all these factors contribute to causing a delay in supply responding to any rise in demand. And then the reverse occurs. When the price is at a high level, marginal projects that weren't profitable before, and supply is incentivized to come online, as long as high prices are sustained. But this creates a pendulum effect where, too much supply actually comes online, and this can cause prices to crash once again. Now, carbon credits, the commodity that carbon capture projects will ultimately create, might behave differently than other commodities. And this doesn't necessarily alleviate all the problems, but cyclicality could be more limited in this scenario. If demand grows as substantially as we might suspect in the carbon credit space, then it would be possible that supply could possibly never catch up, truly. With mandates, green financing, and a small market as it is, if a wave of demand came in, we could have a near perpetual bull market. But obviously, a bull market can't last forever. But it is highly probable that the sector could see, near sustained growth over a long time horizon. So depending on the project, a carbon capture company could have quite a capital-intensive business model. A nature-based project probably won't need to spend an insane amount of money. But direct air capture technology, on the other hand, is certainly quite expensive right now. To give you an example, the scale and cost we'll need to incur to reach net zero, let's take the largest existing direct air capture facility owned by Climeworks. Orca, which can capture around 4,000 tons of carbon dioxide per year. And this is done at a cost of $1,200 per ton, which is absolutely absurd, by the way. The cost of the average carbon credit right now is around $10 or less. But I digress. Orca can suck 4,000 tons of CO2 out of the air per year, which did cost around $15 million to build. Now let's compare that to the total amount of CO2 emissions globally per year. Around 36 gigatons per year, or 36 billion tons of CO2 is emitted. This plant costs $15 million to develop, and it can only capture 4,000 tons per year. So if we want to build plants that will make a significant dent in global CO2 emissions, just imagine the sheer amount of money it would cost to do that, at least with technology as it currently stands. With expenses this large, companies commonly fail. And obviously, the more capital spent on building or maintaining equipment, the fewer funds can be used to acquire new services or products, grow the business organically, or return capital to shareholders. These companies can succeed, as a low margin or bad business can. There is no necessity to buy these stocks whatsoever. You can always choose to buy better business models instead, with the limited capital we have as retail investors. There are certainly some merits to investing in the sector. If timing a market turnaround, commodity markets can provide the most explosive returns of any sector. But there isn't even many possible investment options for pure play carbon capture currently. But I'll link to a video I made covering all the possible options that do exist right now in the description below. But for a recap, the issues I have with carbon capture are ultimately the same ones I have, with any commodity sector. Many of the projects are going to be capital intensive in a cyclical industry, which is at the mercy of broader macroeconomics. And at the same time, there's a low possibility of developing any real moat. Before we end the video, I have a deal for the viewers of the channel. When I'm doing an introductory analysis of a new company, one of the first websites I go to is Simply Wall Street. And this site offers information on a company's potential competitors, valuation statistics, different financial metrics, and my favorite, insider ownership percentages, as well as recent insider transactions. Now, Simply Wall Street's offering the first 100 viewers that use my affiliate link in the description a 40% discount on all their subscription plans. With several to choose from here, and they do also have a free version that allows you to view 5 companies a month. In addition to that, you get a 14-day free trial when you sign up. So check out the link in the description if you're interested in that. But well, everyone, that is going to be the end of the video here. If you liked it, please remember to like and subscribe. Thanks for watching.